Good afternoon to those tuning in from the East Coast, and good morning to our West Coasters. I'm Max Winthrop, CEO at Winthrop Wealth, and today I'm joined by our Co-Chief Investment Officer, Andrew Murphy.
Thanks, Max, and great to be with all of you today. I'm looking forward to it.
So are we. Welcome, and thank you everyone for joining us today for our second Markets in Motion, which is our ad hoc, more free-form webinar series. This series is really intended to be complementary to all the current content that we produce. There's a lot of research and writing that happens behind the scenes to produce this content, and we currently produce three main pieces, which are all available on our website. The first one is our monthly market update. The second is our client question of the month, which is where we seek to answer questions that our clients are bringing to us. And the third are quarterly recap videos. And since we just closed Q3 7 days ago, we're releasing our September market update, our client question, and the video recap right after this webinar. At Winthrop Wealth, we believe thought leadership is the way of the future in this industry, and we believe it's the best way to demystify the wealth management experience. By elucidating the way we think, our thought process, we really seek to do two main things. One is to make it easier for clients to understand the way that we think, and two, educate about financial concepts to better arm you to face your financial futures. There's a lot of firms out there that don't have the capacity to produce their own content. They're using off-the-shelf, mass-produced material. But we truly believe that in this new era of transparency, producing in-house content that is reflective of our collective firm thinking, that translates into real insights and portfolio action is the key. Our investment team, led by Andrew, spends a lot of time analyzing and forming views on global markets, and we spend a lot of time thoroughly understanding our investment exposures and how portfolios may react and perform in various market environments. So by controlling this process, we're able to communicate to our clients in a transparent and efficient manner about what we're doing and why we're doing it. So that's really the key. The goal of this webinar is to address current market moving themes in real time. And so the last one we did was in March. We got a lot of positive feedback. And so we're doing it again. And it's a slightly more informal way to address what's going on from a current event standpoint. Before we get into the market segment, which is where I know everyone wants to spend the time, I just wanted to spend 1 minute on how we approach wealth management. We're a process-driven firm, and as such, we don't look at anything in isolation. We take what we call a total net worth approach to wealth management. It's unique, it's different. It means we're looking at everything together. The financial planning that we do for our clients drives the investment management and the portfolio approach. And if you look at this graphic here, it says, while financial planning and investment management can function successfully on their own, we believe that a combination of the two produces a whole greater than the sum of its parts. So financial planning and investment management work hand in hand at Winthrop Wealth. For our discussion today, we're going to cover what's happening in the equity and fixed income markets and how inflation and the current Fed policy continue to drive volatility. And then also how we're forming our outlook, how we're positioning client portfolios going forward, the fun stuff. So if anyone has questions, just feel free to post them to the chat, and we'll do our best as we get to the end of our session to answer some of those questions for you. So with that, I'm going to hand it over to my esteemed colleague, Andrew, to do a review of the equity markets.
Thanks, Max. So 2022 has been a very difficult year for most equity indices. So if we start by looking at United States market caps, different size companies in the US, the S&P 500 down 23.9% for the year. This is all as of the end of the quarter. Different size companies, mid-size companies, small cap companies down anywhere 22 to 25%. If we look at different styles, growth stocks down about 31%, and value stocks down about 18%. I'll cover kind of what's driven that relative strength in value stocks in a moment. But international markets, whether it's developed international or emerging markets, down about 27%. So just a tough year any way you look at it. And other asset classes haven't done much better. We'll touch on fixed income, but gold is also down about 8%. Cryptocurrency, Bitcoin, down about 60%. So very difficult year. And if we look under the hood in the equity markets, if we look at the 11 US sectors of the S&P 500, the thing that stands out like a sore thumb, the one bright spot is energy. Energy up about 35%. And the reason for that is the increase in the price of oil this year has helped drive strong revenue and strong earnings growth for energy companies. But if we go back to the S&P 500 for a moment, the S&P is having its worst calendar year since 2002. So again, S&P is down 23.9% for the year. And we have had, a few rallies this year. Most recently, we had a really nice rally from mid-June through mid-August, where the market was up almost 18%. But that was pretty much squashed by higher than expected inflation data and the Fed's newfound resolve to raise interest rates to levels that were previously thought unlikely. And unfortunately, the market ended the quarter with a whimper, and we closed at a new year-to-date low of 35.86 for the S&P. 35.86, if we go back for a second, is a level that the market first reached in mid-November of 2020. So on kind of a price return basis, mid-November of 2020 through the end of the quarter, return was zero. On a total return basis, if you were investing dividends, total return's about 3%. And the primary factors driving the market decline this year still remain. We have inflation, we have the Fed tightening monetary policy, we have higher interest rates, we have China's zero COVID policy, and then more recently, we can add the potential European energy crisis and the UK's economic mess to the market's wall of worry. Going forward, the market has a lot of potential catalysts coming up over the next several weeks. So we had one this morning. We had the employment report for September. That came in stronger than expected, but it actually has caused some market weakness. We are firmly in an environment where bad economic news is good news for the stock market because it takes some pressure off the Fed from further tightening monetary policy. So we had a good economic report and a bad market reaction this morning, but we have a lot of other things coming up. We have the third quarter earnings season kicks off next week. And then at the beginning of November, we have the next Fed meeting on the 2nd, and then the midterm elections on the 8th. So there will be plenty to keep investors busy over the next month or so.
So Andrew, thanks for covering the equity front. And let's move to bonds. What's going on in the bond market?
Well, unfortunately, returns have not been much better in the bond market. So we'll start off with a chart. This shows the return of the Bloomberg Barclays Aggregate Bond Index, or the AG, as most people know it as. And the AG acts as a proxy for the investment grade bond market in the United States. This shows calendar year returns. And the AG right now is on pace for its worst calendar year return since inception of the index in 1976. So year to date, the AG is down 14.6%. Actually, prior to this year, the worst calendar year performance the AG had ever had is down 2.9% in 1994. So these type of losses in the bond market are really unprecedented, at least over the last 50 years. And if we look at other types of bonds, have also had a tough period. Corporate bonds down about 19%, high yield bonds down about 15%, and muni bonds down about 12%. And Max, we've gotten a lot of questions from clients about, they've noticed the values of their bond holdings have gone down. We've got a lot of questions of what's caused this. Well, the really simple answer in what's caused most of this is that bond prices move inversely to interest rates. So as interest rates go up, bond prices fall. And the reason that happens is because as interest rates go up, older bonds become less valuable because their coupon payments or their interest payments are now lower than those of new bonds being offered in the market. So the price of those older bonds drop. But I will point out, and I think this is important, that if you bought a bond that's now trading below 100 cents on the dollar, or it's trading at a discount to its par value, unless there's a default, that bond is still going to pay back 100 cents on the dollar at maturity. So the value will recover, but it may just take some time. So again, bond prices move inversely to interest rates, and interest rates have gone up quite a bit this year. So this chart shows the 10-year Treasury yield ended the quarter at 3.83%, and we started the year at 1.51%. So that's a really significant increase in rates in a pretty short amount of time. So the 10-year Treasury yield has more than doubled, or it's increased by 2.32%, or 232 basis points this year. And if we look at kind of just a year-to-date chart of the 10-year Treasury yield, you'll see that really this rapid increase in rates that we've had, that's what's caused the worst bond market environment in nearly 50 years, and that's how you get the ag to fall by nearly 15%.
Andrew, this chart is pretty telling, and we've seen this translate through to the mortgage market is a great example, where pre-pandemic into even 2020 and 2021, with all of the stimulus and easing that occurred, rates on a 30-year fixed mortgage were below 3%. We had some clients get rates in the low to mid 2% for a 30-year fixed. Those rates now are in the mid 5s to low 6s. So there's definitely been a translation. And it does take some time, but we've started to see that in a more major way.
Absolutely. And you know, the three kind of keys for fixed income for us is we'd like fixed income to provide ballast, stability, and income to portfolios, but obviously bonds have not provided ballast this year. So ballast means that when equity markets are decreasing, ideally the fixed income holdings are increasing. And obviously that hasn't happened this year as interest rates have increased. But in the future, you know, going forward, we do expect that negative correlation between stocks and bonds to return in the future once yields level out. And I think it's important just to kind of point out that all else equal, the investment grade bond market just needs yields to stabilize from these levels to achieve positive returns. Yields don't necessarily need to decrease for the bond market to recover, again, just to stabilize. And Max, we've talked about this kind of the silver lining or the bright side to the decline in the bond market this year, and that is the potential future returns. And really, I hope that this is one of the key takeaways from today's webinar. So this chart shows the yield to maturity of the investment grade bond market. And yield to maturity is the estimated rate of return an investor can expect from a bond if purchased today, held to maturity, and assuming there are no defaults. So the yield to maturity on the US aggregate bond index increased to 4.8% at the end of the quarter. And that's the highest level we've seen since 2008. So in other words, future returns from the ag bond index have not been this attractive in 14 years.
Andrew, thanks for mentioning that. And I think, you know, if you look across the board, there's a lot of pain in the asset classes and really owning any assets in 2022. But this silver lining is really going to help our more conservative investors, those who are retired and living off their portfolios, savers, folks who have cash in bank accounts now have an opportunity to take relatively low amounts of risk. T-bills, a great example, Andrew, where we've seen some opportunity lately to earn some additional yield. So that is a nice silver lining because investors are getting paid more to take less risk, and we haven't seen this in quite some time.
Absolutely. And you know, the risk, of course, Max, is that interest rates keep going up and bond prices keep falling. But again, the main point remains is that on a go-forward basis, while the past year has been, or year plus has been painful for bond investors, on a go-forward basis, returns have not been this attractive in a long, long time. So we'll move to the next topic, which is pretty much front page news, or has been front page news, feels like for the last year, year and a half or so, and what's driving a lot of volatility in markets: inflation. So this chart shows several key measures of inflation over the last 3 years, and you can see kind of all measures really declining during the early parts of the pandemic, starting to recover, and then increasing rapidly over the last year or year plus. And while these readings have come down from peak levels, the bottom line is that inflation is still far too high. We have seen some moderation in things like energy, commodities, used vehicle prices, expectation surveys, break-even rates, while stickier categories like wages, shelter, food away from home remain elevated. So moving forward, really the key will be for how long it takes for disinflation to pick up, and for some of these readings, for their levels to move back more toward kind of normalized levels. And certainly, the Fed would very much appreciate a strong period of disinflation. The bond market, interest rates would appreciate a period of disinflation. Equity markets, pretty much everybody is rooting for disinflation at this point. But unfortunately, there just hasn't been enough evidence yet, and the wait continues.
And just to piggyback on that, Andrew, you know, it's something we talk to clients a lot about. It's something we discuss internally a lot, and you referenced it earlier, which in the last couple of weeks, the idea that bad news is good news. So what does that mean? It means, so what typically would be considered bad news, like a slowing in employment, will actually drive a market rally. So the market responds positively to this bad news in a normal environment, because it's focused on, investors are focused on signs of disinflation. And what we've discussed is there's potentially a scenario where the market recovers quickly while the economy continues to worsen.
Absolutely, and we've seen, you know, it's hard to pinpoint it, but generally the equity market probably leads the economy by 6 to 12 months. So we have seen periods where the economy is weakening and the equity market is recovering. Most recently, we saw that kind of coming out of the pandemic in the spring and summer of 2020. And you can especially see that in times where the economy might be weak, but the Fed is easing. Now we have a period where the economy is still doing relatively okay, especially the labor market is still doing okay, but the Fed is tightening and the equity market is weak. So at some point you'll see the flip side of that, because again, the equity market likes to get out in front ahead of the economy. So we'll shift to Fed policy now. I think that's a good segue to talk about kind of what the Fed is thinking. And really the Fed is thinking that inflation is a problem, and they are going to tighten monetary policy to attempt to bring it under control. So they're tightening policy in two ways. Fed is raising interest rates, and they are reducing the size of their balance sheet. So far this year, the Fed has raised interest rates by 3% total, by 300 basis points. And that includes by 75 basis points at 3 consecutive meetings. So now the top end of the federal funds rate stands at 3.25%. So the Fed has done a lot this year already, but they still feel they have a ways to go. So this chart shows the FOMC's summary of economic projections, and the latest shows that the median participant expects the federal funds rate to end 2022 at 4.4%, and then get up to 4.6% in 2023. So in other words, the Fed is expecting to raise interest rates by about another 1.5% or 150 basis points by early next year. And as we kind of just touched on, typically the Fed focuses on balancing maximum employment and price stability. However, in today's environment, the Fed is just hyper-focused on bringing inflation down, even if it means causing a recession, and even if it means causing job losses. So today's kind of strong employment report, today's strong report that showed job gains, is actually counterintuitive to what the Fed is looking for right now, and hence kind of the market weakness today. And we had our Fed Chair Powell, recently admitted that higher interest rates will bring some pain to households and businesses. And that's really as direct as the Fed Chair will be in telling the American people to prepare for a slowing economy.
So, Andrew, knowing all this, what do we think about the future? Where do we go from here? And what are we doing from a portfolio standpoint?
Yeah, and of course, we talk about this very frequently, and our outlook really hasn't changed much in the last few months. We know the risks facing the market, and ultimately they're still here. But I do think it's important to note that really our longer-term outlook on the U.S. equity market, even our longer-term outlook on the bond market, is more optimistic now than it was at the beginning of the year, given the decline we've had. So historically, the S&P 500 has produced a total annualized return of about 9.4%. So we do expect some reversion of the mean after periods of very strong or negative performance. So in the short term, for the market to reach a sustainable bottom, in our view, Fed expectations need to soften. And ideally, that would occur through signs of disinflation. And I'll mention it again, disinflation is really the key to everything right now. It will stop the Fed's aggressive tightening policy. It will help stabilize interest rates. That will help the bond market recover. And it should allow the equity market to put in a real bottom. But over the long term, we do suspect that this difficult economic environment has created a strong buying opportunity for investors that are willing to live with some near-term discomfort.
Thanks, Andrew. Yeah. So while we know past performance is no guarantee of future returns, and it's definitely important to consider your own risk tolerance, financial circumstances, and time horizon prior to investing, this is why it's so important, the planning process, why it's critical. And so how about positioning? What are we doing from a positioning standpoint?
Yeah, so from a positioning standpoint, we entered the year really prepared for volatility. We talked a lot about this in our commentaries last year, that last year had an absence of volatility and we were expecting it to pick up, and it certainly has. So last year we were shifting portfolios more defensively as the market went higher in pretty much a straight line. So on the equity side, still have an overweight toward quality, large cap stocks in the United States. And on the fixed income side, we continue to focus on pursuing ballast stability and income while keeping the interest rate sensitivity a little bit lower than the broader benchmarks. And that positioning really has served us well in 2022 on a relative basis, and we do still feel like it's the best place to be going forward. So we have made some tweaks this year by shifting a little bit more toward value securities, but really the main theme of the year for us is to maintain a long-term viewpoint and a disciplined approach, and continue to look for opportunities to what we call make lemonade out of lemons. So doing things like tax loss harvesting, rebalancing, and selectively putting money to work for clients that have recently made contributions to their accounts.
Thank you. So remember, with what Andrew has said, no strategy assures success or protects against a loss. But what we discussed is essentially how we're approaching the environment today is essentially the same playbook that we followed in 2018 and in 2020 when we had periods of volatility, and it's what will follow whenever there is future market volatility. And this is why it's so important to have a plan and a process in place.
Absolutely. And our main point really is to think in terms of years rather than, say, weeks or months. Buying into the stock market or the bond market, or even holding stocks or bonds today might not look great in a few days or a few quarters, but we do believe that those who are able to either stay invested, rebalance, or add to their existing holdings will eventually be rewarded.
All right. Thank you so much. So that concludes our market segment, and I'm going to keep an eye out for questions. And while we wait for a minute for some of the questions to come in, we have a few. There is something that I wanted to share with everybody today, and it's something that's come up more recently. We know that these times can be scary for people who don't have a plan, and we really got into this business. We were sitting around having lunch, and we were talking about why we love doing what we do. And we got in this business to help people. And we believe the biggest difference we can make is when things get challenging, things get volatile, and the environment is changing or in flux. And so many of you may be receiving financial questions from your family, friends, colleagues, and we just wanted to remind everyone we're here to help, and we're pleased to act as what we call a sounding board for any of these conversations. We're happy to speak to anyone who may have any financial questions or concerns. They're seeking guidance or some clarity to help navigate these challenging times. Obviously, no obligation to become a client, but if they're important to you, they're important to us. So just wanted to share that.